Your head might be spinning with all of this inflation talk. There's all types of ways to torture the data, and there's all different kinds of measurements. There's consumer price index, which the market focuses on. But then there's PCE, personal consumption expenditure, which the Fed likes to look at. These are the two indicators of inflation. As you can see, they typically move in lockstep with each other. Recently, we have seen a divergence where the CPI number has been higher year over year compared to the so-called PCE deflator. Nevertheless, they are telling the same story. For a while there, inflation was cooling, and very recently, it has picked up. We're going to get nerdy here when we talk about inflation. What is the key difference between CPI and PCE, and why does the Fed prefer PCE? Well, number one, they're from different sources. There's different agencies that collect PCE. There's different agencies that collect CPI. To understand why they capture different information, you have to understand that they are reweighted at different intervals. CPI is now reweighted every year, whereas PCE is reweighted every quarter. This is important to understand because when we see high inflation, people switch. You know, they spend less on certain things, they spend more on other things, they trade down. So by reweighting every quarter, you're better capturing what consumers are doing with their spending. Also, CPI comes from consumer expenditures, whereas PCE also captures business expenditure on things that consumers buy. So think about a health insurance company buying drugs on behalf of a consumer. CPI really overweights shelter costs right now. That makes about 30% of the index, and that has been running hotter, whereas the PCE only has it at about 16% of the index. All this to say, the Fed prefers this because it's kind of a more real-time capture. The PCE is a more real-time capture of what consumers are paying for right now. Now that we are out of the weeds, let's tell you what the number did. The most recent reading of inflation, as preferred by the Fed, ticked up by the most that we have seen since June of last year. At the same time, a read of personal spending, so spending by consumers, grew at the fastest pace since 2021. Put those together, you've got a hot economy that the Fed likely needs to cool more in order to bring inflation back in line. And herein lies the market sell-off.